The Dividend Machine. Passive Income for a Lifetime of Wealth. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. Imagine this. Every month, money quietly lands in your bank account. You didn't clock in, hustle for a side gig, or sell anything. You're living your life, whether that's traveling, spending time with family, or pursuing passions, and yet the cash keeps flowing in. That's the power of passive income through dividends. It's a financial engine you can build, one that runs on autopilot, bringing you steady income month after month, year after year. What is the dividend machine? In the world of investing, dividend-paying stocks are one of the most powerful and reliable tools for building wealth. When you invest in companies that pay dividends, you're not just hoping their stock price goes up, you're getting paid regularly, just for owning the stock. And the best part? You can set this machine up once, and with a little maintenance, it keeps working for you, generating passive income for a lifetime. Dividend investing isn't some secret available only to financial experts or Wall Street insiders. It's a strategy that anyone can use, whether you're a seasoned investor or someone completely new to the idea of growing wealth through the stock market. If you've ever wanted a plan to achieve financial independence, to escape the grind of working for every dollar, then this book is your roadmap. Dividend investing is different from other investment strategies. It doesn't rely on market timing or speculation. Instead, it focuses on steady, reliable income that can grow over time. It's about buying into financially sound companies that reward their shareholders with a portion of their profits. Those dividends can then be reinvested to buy more shares, leading to compound growth that accelerates your wealth over time. When you set up your dividend machine, you're building an investment strategy that works even while you sleep. This machine can provide you with a growing stream of income that, over time, can cover your expenses, fund your dreams, or even allow you to retire early. This isn't just about making money, it's about giving yourself choices, whether it's retiring early, traveling the world, or simply having the flexibility to spend your time how you want. Dividend investing can open the doors to the life you've always wanted. We've observed that 67% of our viewers haven't yet subscribed to our channel. We invite you to support us by clicking the subscribe button and liking this video. Your encouragement inspires us to continue creating valuable content for you. Thank you for being a part of our community and fueling our passion for sharing insights and knowledge. Chapter 1. What is financial freedom? Imagine waking up every morning without the weight of financial stress on your shoulders. You no longer have to think about how to stretch your paycheck, whether you can cover your bills, or how long you'll need to keep working just to make ends meet. Instead, you're free to make decisions based on what you want to do, rather than what you have to do. That's what financial freedom is all about. For many, the idea of financial freedom seems like a far-off dream, something reserved for the ultra-rich or those lucky enough to stumble into a windfall. But the truth is, financial freedom is achievable for anyone with the right strategy and mindset. One of the most reliable ways to reach that goal is through dividend investing. Shifting your mindset toward financial freedom. Let's take a moment to break down what financial freedom really means. It's not just having a large sum of money sitting in your bank account. It's about creating a steady, reliable source of income that you can count on, whether you're actively working or not. Dividends provide you with a stream of income, month after month, year after year, without requiring you to sell off your investments or rely on the ups and downs of the stock market. You see, many people think financial independence comes from a single event, like winning the lottery or landing a high-paying job. But true financial freedom comes from consistency, patience, and building wealth over time. That's the beauty of dividend investing. It's not flashy, and it's not about hitting it big. It's about steadily growing your wealth, even while you sleep. This shift in mindset is essential. Dividend investing isn't about chasing quick wins. It's about making small, smart decisions consistently, which compound over time. Imagine planting a tree. In the early years, it may seem small and slow growing. But year after year, as you water it and give it sunlight, it flourishes. One day, that tree is strong enough to provide you with shade, and you realize the time and care you put into it has paid off. That's what we're doing here, planting your financial tree. Now, let's take a more informative look at how dividends work. In simple terms, a dividend is a portion of a company's earnings that gets distributed to shareholders. When you invest in dividend-paying stocks, you're essentially buying a share of that company's profits. Over time, As these dividends accumulate, they can be reinvested to buy more shares, leading to what's called compound growth, a critical component in building long-term wealth. Here's the beauty of dividend investing. You're not relying solely on the stock price to grow your wealth. Instead, you're building an income stream that can eventually replace your need for a traditional paycheck. Whether the stock market is up or down, those dividend payments keep coming in, providing you with a buffer against market volatility. Let's say you've invested in a company that pays a 4% dividend annually. Over time, as that company grows and becomes more profitable, the dividend might increase, providing you with a rising income. Unlike other types of investments that require you to constantly buy and sell, dividends keep working for you, even when you don't touch them. They offer you something most investments don't: passive income. At this point, you might be thinking, is this really possible for me? The answer is yes, it is, no matter where you're starting from. Most people feel trapped in a cycle of working hard, earning money, and then spending it. But imagine if, instead of spending every paycheck, you took a portion of it and put it toward a dividend-paying stock. Over time, that stock would start paying you back, in the form of regular dividend payments. It's a small shift, but it can have a profound impact on your future. The path to financial freedom doesn't require you to become an expert trader or take on massive risks. All it requires is a commitment to long-term thinking and the discipline to make consistent, smart investments. It's not about getting rich quick, but about getting wealthy slowly, in a way that's sustainable and secure. The first step toward financial freedom is shifting your perspective. It's understanding that financial independence is not out of reach. It's about taking control of your financial future by embracing strategies like dividend investing that are designed to work over time. In the next chapter, we'll dive deeper into what makes dividend investing such a powerful tool for building wealth. But for now, I want you to reflect on this. What does financial freedom mean to you? What would your life look like if you didn't have to worry about money every day? Take a moment to visualize that. Because that's what this journey is all about, building a life where money is no longer a source of stress, but a tool for freedom. Chapter 2. Why dividend investing works. You've probably heard stories about people striking it rich through flashy stock market wins or wild investments in startups. But for most of us, those high-risk gambles aren't practical or appealing. If you're looking for a proven, steady path to building wealth, that's where dividend investing comes in. Let's break down what dividend investing really means. When you invest in a company, you're essentially buying a piece of that company, becoming a shareholder. In return, some companies share a portion of their profits with you. These are called dividends. These payments come to you whether the stock price goes up or down, as long as the company continues to generate profits and distribute them. Think of dividend-paying stocks as investments that reward you not just for owning them, but for holding on to them over time. Every quarter, or sometimes even monthly, these companies send you a portion of their profits, which adds up to a significant stream of passive income over time. While other stocks may require you to sell shares to make money, dividend-paying stocks offer you a steady flow of income while you continue to own those shares. It's like getting rent from a property you own, except without having to deal with tenants or property maintenance. This steady stream is what makes dividend investing a powerful tool for long-term wealth building. Why dividends are so powerful? You may be wondering, why should I care about dividends? Dividends aren't just a small bonus, they can be a game changer when it comes to building a stable, reliable income stream. Here are 3 key reasons why dividend investing works so well. 1. One of the biggest advantages of dividend investing is that, unlike growth stocks that only make you money if the price goes up, dividend stocks pay you even when the market is down. The stock market has its ups and downs, and no one can predict where it will go. But as long as you hold quality dividend-paying stocks, those regular payments will keep coming in. This is especially valuable during times of market volatility, when other investors might be panicking. 2. The real secret to wealth. What if I told you that you could not only earn income from dividends but also turn that income into even more money? This is the magic of compound growth. By reinvesting your dividends, meaning using the money you earn from dividends to buy more shares, you can accelerate your wealth building exponentially. Picture this. You invest in a stock that pays you a 4% dividend. Instead of spending that money, you reinvest it, buying more shares. Now you own more shares, which means your next dividend payment is even bigger. And this cycle continues, compounding your returns year after year. Over time, this compounding effect can dramatically increase your wealth. 3. Dividend-paying companies tend to be well-established, profitable businesses. They're often industry leaders with stable cash flows, like major utilities, consumer goods companies, or established tech firms. This makes them less risky compared to high-flying tech stocks or speculative investments. In fact, many dividend-paying stocks belong to a category called dividend aristocrats, companies that have consistently increased their dividends for at least 25 consecutive years. By investing in dividend-paying stocks, you're aligning yourself with companies that prioritize returning profits to their shareholders, making them a safer bet for long-term growth. The proof is in the numbers. You don't just have to take my word for it. History shows that dividend-paying stocks have outperformed the broader market over the long term. According to studies, dividends have accounted for over 40% of the total return of the stock market in the past century. That's right, nearly half of the stock market's returns over time come from dividends, not just price appreciation. When you reinvest those dividends, the effects are even more powerful. In fact, studies show that a portfolio of reinvested dividends can outperform a portfolio without dividends by a significant margin, particularly over the long term. Let's consider an example. Imagine you invested $10,000 in a portfolio of dividend-paying stocks that offer a 4% annual dividend. After 25 years of reinvesting those dividends, your portfolio could be worth nearly $27,000, assuming modest growth in stock prices. That's the power of letting dividends and compounding do the heavy lifting for you. Why dividend investing is ideal for financial freedom. The beauty of dividend investing is that it allows you to take control of your financial future. Instead of being at the mercy of stock market fluctuations, you're building an income stream that's reliable, growing, and potentially endless. Unlike jobs, which require you to trade time for money, dividends keep paying you even when you're not working. This is why dividends are such an effective strategy for reaching financial freedom. They provide you with the freedom of choice, the choice to work less, pursue passions, or retire earlier than you ever thought possible. When you understand that dividends can replace a paycheck over time, your view of investing and wealth changes. You no longer see financial independence as a far-off dream, but as an achievable reality. And once you realize this, everything changes. Now that you have a clear understanding of why dividend investing is such a powerful strategy, it's time to start thinking about how to apply it to your own financial life. As you move forward, consider these questions. What would an extra source of income mean for you? How would it feel to know that your investments are working for you, even when you're not actively managing them? In the next chapter, we'll walk through the practical steps of getting started with dividend investing, from picking your first dividend-paying stocks to building a portfolio that will grow over time. By the end of this book, you'll have everything you need to set yourself on the path to financial freedom through dividends. Chapter 3. Getting started with dividends. Now that you understand why dividend investing is such a powerful tool for building wealth, it's time to take the next step, getting started. Whether you're new to investing or already have some experience, the great thing about dividend investing is that it's straightforward, and you can begin with whatever resources you have at your disposal. Step 1. Before jumping into the stock market, it's important to take a moment and define your financial goals. What do you want your investments to achieve? Are you looking for supplemental income, early retirement, or long-term wealth building? Start by asking yourself, what does financial freedom look like for me? How much passive income do I need to cover my expenses or live comfortably? How long do I have to reach these goals? Knowing the answers to these questions will help you set realistic expectations and choose the right dividend strategy. For example, if your goal is to generate enough dividend income to cover your living expenses, you'll need to calculate how much capital you need to invest to achieve that level of income. Let's say your goal is to receive $40,000 per year in passive income from dividends. If the average dividend yield on your portfolio is 4%, you'll need to invest approximately $1 million in dividend-paying stocks to generate that income. $1 million times 4% equals $40,000. This might sound like a lot, but don't worry. The important thing is to start where you are and build gradually. Dividend investing is a long-term strategy, and every dollar you invest today will get you closer to your goal over time. Step 2. Before you start picking stocks, you'll need to familiarize yourself with some key terms that will help you evaluate dividend-paying companies. Understanding these metrics will give you the confidence to choose strong investments. The dividend yield is the annual dividend payment divided by the stock's current price. It's expressed as a percentage and tells you how much income you'll receive for every dollar you invest. For example, if a stock is priced at $100 and pays a $4 annual dividend, the yield is 4%. $4 divided by $100. In general, higher yields offer more income, but you also want to ensure the company's dividend is sustainable. The payout ratio measures what percentage of a company's earnings are being paid out as dividends. If a company earns $1 per share and pays $0.50 per share in dividends, its payout ratio is 50%. A lower payout ratio often means the company is reinvesting a good portion of its profits back into the business, while a higher ratio could indicate less room for future dividend growth. Look for payout ratios below 75%, as this suggests the company has room to grow its dividends without risking its financial health. The dividend growth rate shows how much a company's dividend payments have increased over time. Companies with a consistent record of increasing dividends are often more reliable and indicate long-term financial stability. This is particularly important because a company that regularly increases its dividend not only pays you more each year but also signals strong underlying business performance. Step 3. Now comes the exciting part, selecting your first dividend-paying stocks. When choosing which companies to invest in, it's important to look beyond the yield alone. Here are some guidelines to help you make smart decisions. Dividend investing is about stability and long-term growth. Start by looking at well-established companies with a long track record of paying dividends. These companies are often called blue-chip stocks, and they include industries like consumer goods, utilities, telecommunications, and healthcare. One good starting point is the list of dividend aristocrats. These are companies in the S&P 500 that have increased their dividends for at least 25 consecutive years. Investing in dividend aristocrats can provide a strong foundation for your portfolio because these companies have proven they can weather economic downturns while continuing to reward shareholders. To reduce risk, aim to invest in a diverse range of sectors. Relying on just one industry can expose you to too much risk. For example, if you invest heavily in energy stocks and the price of oil drops, your dividend payments may suffer. Instead, spread your investments across different industries to protect yourself from volatility in any one sector. Step 4. To start investing in dividend-paying stocks, you'll need a brokerage account. The good news is that opening an account is easier and more accessible than ever. Many online brokers allow you to start with low minimum balances and offer commission-free trades. When choosing a brokerage, consider: look for a brokerage with low or no trading fees. Dividend reinvestment plans DRIPs. Some brokerages offer DRIPs, which automatically reinvest your dividends into more shares of the stock. This helps maximize your compound growth. Make sure the platform is easy to use, especially if you're new to investing. Once you've opened your account, funded it, and selected your first stocks, congratulations, you've officially begun your dividend investing journey. Step 5. Now that you've taken your first steps, it's important to remember that dividend investing is a long-term strategy. You'll want to regularly monitor your portfolio and reinvest your dividends to maximize growth. Reinvesting dividends is one of the most powerful ways to grow your wealth, because it allows you to compound your returns. Each time you receive a dividend payment, that money buys more shares, which in turn generates more dividends, and so on. Let's take a moment to reflect on what you've done so far. You've taken the first step toward building passive income, which means you're no longer relying solely on your job to support your financial future. By shifting your focus from traditional earnings like a salary to building wealth through dividends, you've opened the door to a future where your money works for you. Imagine a life where the income from your investments covers your living expenses, allowing you to spend more time on the things you love, whether it's traveling, pursuing a passion, or spending time with family. This is the long-term vision of financial freedom, and dividend investing is your vehicle to get there. You've now got the tools to get started with dividend investing, but this is just the beginning. In the next chapter, we'll dive deeper into building a well-rounded dividend portfolio that can withstand the test of time and provide steady, growing income. You'll learn how to balance high-yield stocks with dividend growers and how to diversify across industries. So take a deep breath, you've already made great progress. Your financial future is already looking brighter. Chapter 4. Building your dividend portfolio. Now that you understand the fundamentals of dividend investing and have taken your first steps, it's time to take a deeper dive into constructing a well-rounded dividend portfolio. Your portfolio is the foundation of your wealth-building strategy, and the key to long-term success is diversification and balance. A strong portfolio not only provides a reliable stream of income, but it also helps protect you from the inevitable ups and downs of the market. One of the most important principles of investing is diversification. Diversification is the process of spreading your investments across different sectors, industries, and types of assets to reduce risk. Think of it as not putting all your eggs in one basket. If one company or sector suffers, the others in your portfolio can help balance out the losses, keeping your income stream steady. When it comes to dividend investing, diversification also means holding stocks that have different dividend characteristics. For example, some companies pay high dividends but may not have a lot of growth potential. These are often in more mature industries like utilities or telecom. Others may have lower yields but are known for consistent dividend growth, making them valuable long-term holdings. Think tech companies or consumer goods. By holding a mix of both high yield and dividend growth stocks, you can build a portfolio that provides both immediate income and future growth. For example, balancing high yield and dividend growth stocks. Imagine you hold a utility company that pays a 6% dividend and a tech company that only pays 2%. The utility company provides you with a higher income today, but it may not grow much over the next few years. Meanwhile, the tech company's lower dividend may grow by 10 to 15% annually, which means that in a few years, it could match or even exceed the utility stock's income. By owning both, you're balancing the stability of income with future growth potential. Now let's look at how to choose the right dividend stocks to create a diversified portfolio. As we discussed in the last chapter, dividend aristocrats are a great starting point. These are companies in the S&P 500 that have increased their dividends for 25 consecutive years or more. Investing in dividend aristocrats can give you a solid foundation because these companies have proven they can weather economic downturns while still rewarding shareholders. Some well-known dividend aristocrats include Johnson & Johnson J&J, a healthcare giant with a long history of dividend growth. Procter & Gamble PG, a consumer goods company that's been increasing dividends for over 6 decades. Coca-Cola Co., a leader in the beverage industry, known for consistent dividend payments. These companies offer reliability, making them ideal for the core of your portfolio. Add some high-yield stocks. Once you've established the core of your portfolio with reliable, dividend-growing companies, consider adding a few high-yield stocks. These are companies that may not have as much growth potential but offer higher dividend payouts today. High-yield stocks often come from sectors like utilities, companies that provide essential services like electricity or water and are often recession-proof. Real estate investment trusts, REITs. These companies invest in real estate and are required by law to pay out at least 90% of their taxable income as dividends. While high-yield stocks can be attractive for immediate income, it's important not to rely too heavily on them. These companies may be more vulnerable to economic downturns, and their dividends may not be as sustainable over the long term. Balancing high-yield stocks with more stable, dividend growth companies is key to creating a resilient portfolio. Diversifying across sectors. In addition to balancing high-yield and dividend growth stocks, you'll also want to diversify across different sectors of the economy. This helps protect your portfolio from downturns in any one industry. Here are some sectors to consider. Consumer staples. These are companies that produce essential goods, like food and household products. They tend to be stable and offer consistent dividends, even during economic recessions. Companies in the healthcare sector often provide solid dividend growth, as they benefit from long-term trends like aging populations. While tech companies are not always known for high dividends, many established tech giants like Microsoft and Apple offer dividends that grow over time, making them a great addition to your portfolio. Banks and financial institutions often pay solid dividends, and as the economy grows, so does their business. Utilities and energy. These companies provide essential services, making them stable dividend payers. However, they can be more sensitive to interest rate changes, so it's important to balance them with other sectors. By diversifying across sectors, you'll create a more resilient portfolio that can weather economic shifts while continuing to generate income. Rebalancing your portfolio. Once you've built your dividend portfolio, it's important to rebalance it periodically. Rebalancing means adjusting your holdings to ensure that your portfolio remains diversified and aligned with your goals. For example, if one stock grows significantly in value, it could end up taking up a larger percentage of your portfolio, increasing your risk exposure. Rebalancing ensures that no single stock or sector becomes too dominant, maintaining the right balance between growth and income. A yearly review of your portfolio helps ensure that it remains diversified and aligned with your long-term goals. After major market changes. If there's a significant market correction or a major shift in a particular industry, it might be worth reviewing your portfolio to see if adjustments are needed. Using dividend reinvestment plans. As we discussed earlier, reinvesting dividends is one of the most powerful ways to grow your wealth. Many brokerages offer dividend reinvestment plans, which automatically use your dividend payments to purchase additional shares of the stock that paid the dividend. For example, if you receive a $50 dividend from a stock and the stock is priced at $100, the DRIP would use that $50 to purchase half a share. Over time, as more shares accumulate, your dividend payments will grow, allowing the process to compound. Reinvesting dividends is particularly beneficial in the early stages of your investment journey, as it maximizes your returns and helps you build wealth faster. Imagine your portfolio 10 or 20 years from now. You've steadily added high-quality dividend-paying stocks, reinvested your dividends, and maintained a diversified, balanced portfolio. At this point, your portfolio is generating enough income to cover your living expenses or supplement your retirement. The key to success is staying disciplined and consistent. Dividend investing isn't a get-rich-quick strategy. It's a long-term plan for financial independence. The beauty of this approach is that it doesn't require constant attention or stress. By building a solid, diversified portfolio and letting your dividends compound over time, you'll eventually reach a point where your money is working for you, even while you sleep. With a well-diversified dividend portfolio in place, you're well on your way to achieving financial freedom. In the next chapter, we'll dive into one of the most important aspects of investing, the power of compound growth. You'll learn how compounding works and why it's such a critical factor in building long-term wealth. Take a moment to reflect on the progress you've made so far. You're not just investing in stocks, you're building a future where your financial security is no longer dependent on your day-to-day work. That's the power of dividend investing. Chapter 5. Compound Growth. The Magic of Reinvesting. If there's one thing that separates those who achieve financial independence from those who struggle with their finances, it's the ability to harness the power of compound growth. Often referred to as the eighth wonder of the world, compound growth is the process by which your money grows exponentially over time, all thanks to the simple act of reinvesting. Let's start by breaking down what compound growth is. In its simplest form, compounding means earning returns on your original investment plus any earnings those investments generate. In the case of dividend investing, it means you're not just earning dividends on the shares you own, you're also earning dividends on the dividends you've already reinvested. Over time, this creates a snowball effect, where your wealth grows faster and faster. To illustrate this, imagine you invest $10,000 in a dividend stock that yields 5%. At the end of the year, you earn $500 in dividends. Now, instead of spending that $500, you reinvest it back into more shares of the stock. The next year, you're not just earning dividends on your original $10,000, you're also earning dividends on the extra $500 you reinvested. Over time, this cycle repeats, and your wealth begins to compound at an increasing rate. The beauty of compound growth is that it rewards patience and discipline. The longer you allow your dividends to be reinvested, the faster your portfolio will grow. Time is one of the most critical factors in harnessing compound growth. The earlier you start investing and reinvesting dividends, the more powerful the compounding effect becomes. Let's look at an example. Say you invest $10,000 in a dividend stock with a 5% yield. If you reinvest those dividends every year, here's what your portfolio might look like over time. After 10 years, $16,470. After 20 years, $27,126. After 30 years, $44,677. As you can see, the real magic happens over the long term. After 10 years, your portfolio grows steadily, but after 20 or 30 years, the growth becomes exponential. This is why dividend investing and reinvesting your dividends is such a powerful strategy for building wealth. It's not about getting rich quickly, it's about getting wealthy slowly, methodically, and sustainably. To show how powerful compound growth can be, let's look at a real-life example. Grace Groner. Grace was an ordinary woman who lived in Illinois and worked as a secretary for most of her life. She wasn't wealthy, and she never earned a huge salary. But in 1935, she bought $180 worth of stock in Abbott Laboratories. Over the next 75 years, she reinvested her dividends faithfully. By the time she passed away in 2010, her $180 investment had grown to an astonishing $7 million. How did she achieve this? Through the power of compound growth and the discipline to stick with her investment strategy over the long term. Grace's story isn't unique. It shows that you don't need a huge initial investment to build significant wealth. You simply need to let time and compounding do the heavy lifting. How reinvesting your dividends boosts growth. The most effective way to take full advantage of compound growth is by reinvesting your dividends. Many brokerages offer dividend reinvestment plans, which allow you to automatically reinvest your dividends into more shares of the same stock. This process is seamless and ensures that every dollar your investments generate goes back to work for you. When you reinvest dividends, you're essentially buying more shares of stock without having to put in any additional money. As your dividend income grows, you acquire more shares, and as you acquire more shares, your dividend income increases. It's a virtuous cycle that keeps growing stronger as time passes. Imagine starting with $1,000 invested in a stock that pays a 4% annual dividend. In year 1, you earn $40 in dividends, which you reinvest. Now, in year 2, you're earning dividends on $1,040, and so on. By year 5, your investment has grown to $1,217 without you having to add any extra money. The more you reinvest, the faster your wealth compounds. This snowball effect is the core reason why dividend investing is such a powerful tool for achieving financial freedom. Over time, your money works harder and harder for you, without you having to do anything other than stay disciplined and patient. The key to success. One of the hardest parts of investing is staying patient. When you first start dividend investing, it might feel like your portfolio is growing slowly. But that's the nature of compound growth. It's slow at first, but once it gets going, the results are exponential. Shifting your mindset from short-term gains to long-term wealth building is crucial. The key to mastering compound growth is patience. The longer you allow your dividends to reinvest, the more powerful the compounding effect becomes. It might take 5, 10, or even 20 years before you see significant growth, but when it comes, the rewards are life-changing. Let's consider the story of Warren Buffett, one of the most successful investors of all time. Buffett didn't become a billionaire overnight. In fact, most of his wealth came later in life, as the effects of compound growth accumulated. Buffett once said, "The best investment you can make is in yourself." But his second best investment? Reinvesting dividends and letting compound growth work its magic. To maximize the power of compound growth, here are a few tips to keep in mind. 1. Start as early as possible. The earlier you start reinvesting your dividends, the more time compounding has to work its magic. Don't worry if you don't have a lot of money to invest up front. Even small amounts grow significantly over time when compounded. 2. Consistency is key. Continue reinvesting your dividends, even when the market is down. This is where the discipline of long-term investing pays off. Over time, those reinvested dividends will generate more income, creating a compounding snowball effect. 3. Let time work for you. Remember, compound growth is most effective over the long term. The longer you allow your dividends to compound, the greater the impact. This is a marathon, not a sprint. The long-term vision of financial freedom. Let's step back and think about the long-term vision of dividend investing and compound growth. When you start this journey, the results may seem modest. You may receive a small dividend check, and the impact might not seem significant. But over time, as your portfolio grows and your dividends compound, the results will be nothing short of transformative. Imagine that 10 or 20 years from now, you've built a portfolio that's generating enough passive income to cover your living expenses, travel, or retire early. This is the vision of financial freedom that dividend investing can offer. It's not about instant wealth, it's about building sustainable wealth over the long term. In the next chapter, we'll explore how to manage risk and diversify your portfolio to protect your investments from market volatility. While dividend investing is a powerful tool for wealth building, it's important to understand the risks and how to safeguard your portfolio for the long haul. Take a moment to reflect on the power of compound growth. It's one of the most incredible forces in investing, and by staying patient and consistent, you're setting yourself up for a lifetime of financial security. Chapter 6: Risk Management and Diversification. Investing always involves some level of risk, but understanding how to manage that risk is one of the most important skills any investor can develop. In the world of dividend investing, risk management doesn't just protect your portfolio, it ensures that you're building a sustainable stream of income that can withstand market volatility. In this chapter, we'll explore strategies to diversify your portfolio, manage risk, and make sure your dividend income remains stable, even in tough economic times. Why risk management is critical. Let's start by addressing the reality of investing. All investments carry risk. Stock prices fluctuate, companies face challenges, and the economy goes through cycles of growth and recession. While dividend stocks tend to be more stable than many other investments, they're not immune to market downturns. This is why risk management is essential. Risk management isn't about avoiding risk entirely, that's impossible in investing. Instead, it's about minimizing risk while maximizing your potential for long-term gains. The goal is to build a portfolio that can weather the storm when the markets are down, ensuring that your dividend payments remain reliable, even in uncertain times. One of the most effective ways to manage risk in your portfolio is through diversification. Diversification is the practice of spreading your investments across different sectors, industries, and asset classes so that no single investment can significantly harm your overall portfolio. Think of diversification as your safety net. When one part of your portfolio is underperforming, another part may be doing well, helping to balance out your total returns. To understand diversification, let's first look at sectors. The economy is divided into different sectors, such as healthcare, technology, consumer goods, energy, and utilities, and each sector reacts differently to market conditions. Some sectors, like consumer staples companies that produce essential goods like food and household items, tend to perform well during recessions, while others, like technology or financials, may be more sensitive to economic cycles. By investing in companies from multiple sectors, you reduce the risk that a downturn in one industry will significantly impact your overall portfolio. Example: let's say you've invested heavily in the energy sector. If oil prices plummet due to a supply glut, your energy stocks might take a hit. However, if you also hold dividend stocks in sectors like healthcare or consumer goods, which are less affected by oil prices, those investments can help cushion the blow and keep your income stream more stable. A well-diversified dividend portfolio might include healthcare stocks, known for stability and consistent dividend growth due to the constant demand for healthcare services. Consumer staples. Companies that produce everyday products tend to remain profitable even in economic downturns. These companies provide essential services like electricity and water, making them less susceptible to economic cycles. Technology. While tech stocks are typically known for growth rather than dividends, many established tech companies now offer dividends that grow over time. By spreading your investments across sectors, you reduce the likelihood that a downturn in one area will have a major impact on your portfolio. Another important aspect of diversification is geographic diversification. Many investors focus solely on US-based companies, but by expanding your investments globally, you can reduce your exposure to risks specific to the US economy. Different regions of the world often go through economic cycles at different times. By investing in dividend-paying companies from countries like Canada, Europe, or emerging markets, you can benefit from growth in these regions while reducing the impact of a downturn in your home country. Let's say you've built a portfolio that includes only US companies, and the US enters a recession. If your portfolio is diversified globally, with investments in European or Asian companies, those international stocks might perform better, helping to balance out the effects of the US recession on your portfolio. Global diversification helps protect your portfolio from regional economic shocks and opens up opportunities to invest in companies that may be leading in different sectors, such as renewable energy in Europe or technology in Asia. In addition to diversifying across sectors and geographies, it's also important to diversify within sectors. Even the best companies can face challenges, new regulations, shifting consumer preferences, or industry-specific disruptions that could impact their profitability. This is why you should avoid putting too much of your portfolio into a single company, even if it's a well-established dividend payer. No company is immune to risk, so it's important to spread your investments across several dividend-paying companies to mitigate company-specific risk. Consider the case of General Electric. For decades, they were the most reliable dividend payers, and many investors saw it as a safe bet. However, in the late 2000s they faced financial difficulties and was forced to cut its dividends significantly. Investors, who had relied too heavily on GE for dividend income, were left scrambling. By holding multiple companies within the same sector, you protect yourself from the possibility of one company's dividend being cut or eliminated. If one company in your portfolio reduces its dividend, the other companies can help ensure your overall income remains stable. While high-yield stocks can be attractive for generating income, they often come with higher risks. Companies that offer extremely high dividend yields, let's say 8% or more, may be signaling that they are in financial trouble or are over-leveraged. If a company's dividend yield is significantly higher than its peers, it's important to ask why. To avoid over-concentration in high-yield stocks, balance these investments with dividend growth stocks, companies that may offer lower yields today but have a strong track record of increasing their dividends over time. This strategy provides a mix of both immediate income and long-term growth. Diversification isn't a one-time event, it's an ongoing process. As market conditions change, some sectors or stocks in your portfolio may outperform others, causing your portfolio to become unbalanced. When this happens, it's important to rebalance your portfolio to maintain the proper mix of sectors, regions, and company sizes. Rebalancing involves adjusting your portfolio to ensure that no single investment or sector takes up too large a share of your holdings. For example, if your technology stocks have grown significantly, they may now represent a larger portion of your portfolio than you intended. By rebalancing, you would sell some of those shares and reinvest in other sectors to maintain diversification. You should consider rebalancing your portfolio. A yearly review of your portfolio helps ensure that it remains diversified and aligned with your long-term goals. After major market changes, if there's a significant market correction or a major shift in a particular industry, it might be worth reviewing your portfolio to see if adjustments are needed. Transforming risk into opportunity. Here's where we incorporate the transformative approach. Managing risk is not just about playing defense, it's about transforming risk into opportunity. By understanding how to diversify and manage risk, you're not only protecting your wealth, but you're also creating a stable foundation for long-term financial success. Imagine that even during the worst market downturns, you're still receiving regular dividend payments because you've built a resilient, diversified portfolio. While others are panicking, you're confidently sticking to your plan, knowing that your portfolio is designed to withstand tough times. In the next chapter, we'll explore the tools and resources you can use to analyze dividend-paying stocks and monitor your portfolio. You'll learn how to assess a company's financial health, dividend sustainability, and long-term growth potential, ensuring that you're making informed decisions. Remember, risk is a natural part of investing, but by managing it wisely through diversification and regular rebalancing, you're setting yourself up for long-term success. You're not just investing in stocks, and you're investing in your future financial freedom. Chapter 7. Tools and Resources for Smart Investing. By this point, you've built a diversified dividend portfolio and learned how to manage risk, but there's one more important piece of the puzzle: staying informed. To ensure that your dividend investments are working for you over the long term, it's essential to use the right tools and resources to evaluate stocks, monitor your portfolio, and stay up to date on market trends. In this chapter, we'll explore the tools and strategies that can help you make smart decisions, whether you're researching a new stock or checking on your existing investments. One of the most critical steps in dividend investing is choosing the right companies to invest in. Fortunately, there are many resources available to help you research dividend-paying stocks and assess their potential for long-term growth. 1. Several financial news websites offer free tools for researching dividend stocks. These platforms provide information about companies' dividend histories, yields, and payout ratios, allowing you to make informed decisions. Some of the most popular include Yahoo Finance. This platform offers detailed financial information on stocks, including historical dividend data, yield percentages, and payout ratios. You can also track your portfolio and set up alerts for dividend payments. Morningstar, known for its in-depth analysis, Morningstar provides detailed reports on individual stocks, including dividend sustainability scores and company fundamentals. Seeking Alpha. This platform focuses heavily on dividend investing, offering in-depth articles and analysis from contributors. It also has a feature called Dividend Grades, which allows you to see how well a company's dividend holds up in terms of safety and growth potential. Let's say you're interested in a particular stock and want to assess its dividend history. By entering the company's ticker symbol into Yahoo Finance, you'll be able to see its dividend yield, payout ratio, and recent dividend payments. You can also check the dividend history to see if the company has consistently increased its dividend over time, which is a strong indicator of its financial health and long-term sustainability. 2. Stock screeners are invaluable tools for narrowing down the list of potential investments. These tools allow you to filter stocks based on specific criteria, such as dividend yield, payout ratio, or market capitalization. Some useful stock screeners include FinViz, a popular and user-friendly stock screener that allows you to filter stocks based on various metrics, including dividend yield and sector. Yahoo Finance Screener. This tool allows you to filter stocks based on dividend yield, payout ratio, and earnings growth, helping you find companies that meet your criteria. Fidelity Stock Screener. If you have a brokerage account with Fidelity, you can use their advanced stock screener to filter for dividend-paying stocks and assess various financial metrics. Imagine you're looking to diversify your portfolio by adding high-yield dividend stocks from the utility sector. By entering specific criteria into a stock screener, dividend yield above 4%, utilities sector, market cap over $10 billion, the screener will return a list of stocks that match your criteria, helping you make a more targeted decision. Once you've built your portfolio, it's important to monitor your dividend income and track the performance of your investments. Dividend trackers help you keep an eye on your total dividend income, track upcoming dividend payments, and ensure you're reinvesting dividends effectively. 1. There are several apps available that can help you manage your dividend portfolio and track your income. Track Your Dividends. This app allows you to track your dividend payments, portfolio yield, and dividend growth rate. It also shows you the projected annual income from your dividend stocks, helping you stay on track with your financial goals. ShareSite. A comprehensive portfolio tracker that offers detailed reports on dividend income, reinvestment, and overall portfolio performance. You can track multiple portfolios and see real-time updates on your dividend payments. Dividend Tracker. This app allows you to enter your dividend-paying stocks and provides a clear overview of your expected dividend income, upcoming payments, and overall portfolio performance. Using Track Your Dividends. Let's say you want to track your portfolio's dividend yield and monitor your upcoming payments. By entering your stock holdings into Track Your Dividends, you can instantly see your total dividend income, projected future income, and portfolio yield. This helps you stay organized and ensures you're maximizing your passive income potential. When selecting dividend stocks, it's not enough to look at the yield alone. You also need to assess whether the company's dividend is sustainable over the long term. Fortunately, several resources can help you evaluate a company's dividend sustainability. 1. The dividend payout ratio is one of the most important metrics for evaluating dividend sustainability. It shows what percentage of a company's earnings are being paid out as dividends. In general, a payout ratio below 75% is considered sustainable, while a higher ratio may indicate that the company is overextending itself. You can find a company's payout ratio on most financial websites, including Yahoo Finance and Morningstar. 2. A company's cash flow is another critical factor in determining dividend sustainability. Companies with strong cash flow are more likely to maintain or increase their dividend payments over time. You can find information on a company's cash flow in its quarterly earnings reports, or through financial analysis platforms like Seeking Alpha or Morningstar. Imagine you're considering investing in a stock with a 6% dividend yield. Before making a decision, you check the company's payout ratio and find that it's at 80%. This high payout ratio could be a warning sign that the company may struggle to maintain its dividend in the future. You also look at the company's cash flow and notice that it's declining, further indicating potential issues with dividend sustainability. With this information, you may decide to look for a more sustainable investment. Once you've built your dividend portfolio, you'll want to monitor it regularly to ensure it remains diversified and aligned with your long-term goals. Several tools can help you keep track of your investments and make informed decisions about when to rebalance or add new stocks. 1. Many brokerage accounts offer built-in portfolio monitoring tools that allow you to track your investments in real time. For example, Fidelity and Charles Schwab offer portfolio analysis tools that show you your portfolio's sector allocation, dividend yield, and performance metrics. Vanguard provides portfolio tracking and performance analysis, including tools to help you monitor your dividend income and reinvestment progress. 2. Google Sheets or Excel. For those who prefer more customization, creating your own Google Sheet or Excel spreadsheet can be an effective way to track your dividend portfolio. By setting up a simple tracking system, you can input your dividend payments, reinvestment amounts, and portfolio value, giving you a personalized overview of your investments. Imagine you log into your Fidelity account and use their portfolio analysis tool. You notice that your tech stocks have grown significantly and now represent 40% of your portfolio, which is more than you intended. By using this tool, you can see that it's time to rebalance your portfolio and reinvest in sectors that are underrepresented, ensuring that your portfolio stays diversified and aligned with your goals. Now, let's shift to the transformative approach. By learning how to use these tools and resources, you're not just becoming a more informed investor, you're building the confidence to take control of your financial future. These resources empower you to make smart decisions and ensure that your investments are aligned with your long-term goals. Investing doesn't have to feel overwhelming. With the right tools at your disposal, you can confidently manage your portfolio, track your progress, and stay on course to achieve financial freedom. Remember, dividend investing is a journey, and staying informed is a critical part of that journey. In the next chapter, we'll explore how to analyze dividend stocks, focusing on understanding key financial metrics and evaluating a company's overall health. By the end of that chapter, you'll be equipped to select strong, sustainable dividend stocks with confidence. For now, take a moment to explore some of the tools and resources we've discussed. Try using a stock screener or portfolio tracker to get a sense of how these tools can simplify your investing process and keep you on track to achieving your financial goals. Chapter 8. How to analyze dividend stocks. Dividend investing isn't just about picking companies that pay high dividends, it's about choosing companies that have the financial strength and stability to continue paying and growing their dividends over time. In this chapter, we'll explore the key financial metrics and strategies you can use to evaluate dividend-paying companies and ensure that your investments are set up for long-term success. When analyzing dividend stocks, there are several key metrics that you should always look at. These financial metrics will give you a clearer picture of a company's ability to pay and grow dividends over time, its overall financial health, and the sustainability of its business model. 1. The dividend yield is one of the first metrics most investors look at when evaluating a dividend stock. It represents the percentage of a company's share price that it pays out in dividends each year. A higher dividend yield can mean more income, but it's important not to focus solely on yield, especially if it's unusually high compared to peers. Let's say you're looking at two companies. The first company has a dividend yield of 6%. The second company has a dividend yield of 2.5%. At first glance, the first company might seem more attractive, but a high yield can sometimes be a red flag that the company is in financial trouble. To determine whether the high yield is sustainable, you'll need to dig deeper into the company's other financials, such as its payout ratio and cash flow. 2. The dividend payout ratio tells you what percentage of a company's earnings are paid out as dividends. A lower payout ratio suggests that the company has more room to grow its dividends, while a higher ratio might indicate that the company is paying out too much of its earnings, leaving little room for reinvestment. As a general rule of thumb, a payout ratio below 50% is often considered safe and suggests the company has room to grow its dividend. A payout ratio above 75% might be a warning sign that the company could struggle to maintain its dividend during difficult times. The first company has a payout ratio of 80%, meaning it pays out 80% of its earnings as dividends. This might be concerning because the company is retaining very little to reinvest in growth or handle unexpected expenses. The second company, on the other hand, has a payout ratio of 40%, indicating that it has a solid balance between rewarding shareholders and reinvesting in the business. 3. While the payout ratio looks at earnings, free cash flow (FCF) is another critical metric to assess dividend sustainability. Free cash flow represents the cash a company generates after accounting for capital expenditures. It's a more reliable indicator of how much money the company has available to pay dividends, because dividends come directly from cash, not accounting profits. A company with strong free cash flow is more likely to be able to maintain and grow its dividend over time, while a company with weak or negative free cash flow may struggle to sustain its payouts. Example: Company C has strong earnings but negative free cash flow due to high capital expenditures. Despite positive earnings, the company may struggle to maintain its dividend because it lacks the cash flow to support it. Company D, in contrast, has strong free cash flow, even though its earnings are modest. This suggests that the company is generating enough cash to comfortably cover its dividend payments and potentially grow them over time. 4. The dividend growth rate measures how much a company's dividend has increased over time. A company with a strong track record of increasing dividends is often a good sign of financial strength and a shareholder-friendly management team. Consistent dividend growth indicates that the company is not only committed to returning profits to shareholders, but also confident in its future earnings potential. For example, Company E has increased its dividend by an average of 8% per year for the past 10 years. This suggests that Company E is financially healthy and prioritizes rewarding shareholders through consistent dividend hikes. Company F, on the other hand, has not increased its dividend in several years, signaling that the company may not have the financial flexibility to reward shareholders with growing payouts. Analyzing a company's financial health. Beyond these dividend-specific metrics, it's important to look at the overall financial health of the company. Strong financials suggest that the company will be able to continue paying and growing dividends over the long term, while weak financials might indicate that the company's dividend is at risk. 1. The debt-to-equity ratio measures a company's leverage, or how much of its operations are funded by debt compared to shareholders' equity. A high debt-to-equity ratio could be a sign that the company is over-leveraged and may struggle to meet its dividend obligations, especially during economic downturns. A lower debt-to-equity ratio indicates a more financially stable company. For example, Company G has a debt-to-equity ratio of 1.5, meaning it has $1.50 in debt for every $1 of equity. This could be a sign that the company is over-reliant on debt, which might make it more vulnerable during tough economic times. In contrast, Company H has a debt-to-equity ratio of 0.5, meaning it has only $0.50 of debt for every $1 of equity, indicating a more conservative and stable financial position. 2. A company's earnings growth is another key factor in evaluating its dividend potential. Companies with strong, consistent earnings growth are more likely to increase their dividends over time. If earnings are declining or stagnant, the company may eventually be forced to cut its dividend. For example, Company I has grown its earnings by 10% annually for the past 5 years. This suggests that the company is expanding and could have the ability to grow its dividend in the future. Company J, however, has seen its earnings decline by 5% annually, which could be a warning sign that the company might cut its dividend in the future to preserve cash. 3. Return on equity (ROE) measures how efficiently a company uses shareholders' equity to generate profits. A higher ROE indicates that the company is effective at converting shareholder investments into earnings, which often translates into better dividend growth prospects. Look for companies with ROE consistently above their peers or industry averages. Example: Company K has an ROE of 15%, meaning it generates $0.15 in profit for every $1 of shareholder equity. This suggests that the company is efficiently using its resources and may have more room to grow its dividend. Company L, on the other hand, has an ROE of 5%, indicating that it is not as efficient at generating profits, which might limit its ability to raise dividends in the future. One of the most critical aspects of dividend investing is ensuring that the company's dividend is safe and sustainable. Here are a few ways to analyze dividend safety. 1. Dividend coverage ratio. The dividend coverage ratio measures how easily a company can cover its dividend payments from earnings. A higher ratio indicates a safer dividend, as the company has more than enough earnings to cover its dividend obligations. For example, Company M has a dividend coverage ratio of 3, meaning its earnings can cover the dividend payment 3 times over. This suggests a very safe dividend. Company N has a dividend coverage ratio of 1.1, meaning its earnings barely cover its dividend. This could be a sign that the dividend is at risk of being cut if earnings decline. 2. Dividend safety scores. Some research platforms, like Simply Safe Dividends or Morningstar, offer dividend safety scores, which evaluate the likelihood that a company will continue to pay and grow its dividends. These scores take into account a variety of financial metrics and give you a simple, easy-to-understand rating of the company's dividend safety. For example, Company O receives a high dividend safety score from Simply Safe Dividends, indicating that its dividend is secure and likely to continue growing. Company P, however, receives a low score, suggesting that its dividend is at risk of being cut in the near future. Building confidence in stock analysis. Learning how to analyze dividend stocks might feel daunting at first, but by mastering these key financial metrics, you're building the confidence to make informed, independent investment decisions. You're not just relying on luck or chance, you're using data and sound financial principles to ensure that your investments are sustainable. By evaluating a company's dividend yield, payout ratio, free cash flow, and overall financial health, you're setting yourself up for long-term success. Over time, you'll find that analyzing stocks becomes second nature, allowing you to confidently build a portfolio that aligns with your financial goals. In the next chapter, we'll explore common pitfalls in dividend investing and how to avoid them. By understanding the potential mistakes that investors often make, you'll be better equipped to stay on course and achieve your long-term financial goals. For now, take some time to practice analyzing a few dividend-paying companies using the metrics we've discussed. The more you practice, the more confident you'll become in selecting the right stocks for your portfolio. Chapter 9. Common pitfalls to avoid in dividend investing. Dividend investing, when done right, can be one of the most reliable paths to financial freedom. However, like any investment strategy, there are pitfalls that can trip you up if you're not careful. The good news is that by recognizing these mistakes early and taking steps to avoid them, you can stay on course and continue building a sustainable, income-generating portfolio. In this chapter, we'll explore the most common mistakes that dividend investors make and how you can steer clear of them. Pitfall 1. Chasing high yields. One of the most common mistakes new dividend investors make is chasing high yields. It's easy to be tempted by a stock that offers a 10% or even 15% dividend yield, especially when you compare it to a more modest 3% or 4% yield. But remember, a high yield often comes with high risk. High yield stocks may be offering such attractive payouts because the company is struggling financially, and its stock price has dropped significantly. In many cases, a company that offers an unusually high yield is signaling trouble ahead. The dividend may not be sustainable, and the company could be forced to cut or eliminate it altogether, leaving you with both reduced income and a potential loss of principal. How to avoid it. Look beyond the yield. When evaluating a dividend stock, don't just focus on the yield percentage. Instead, analyze the company's dividend payout ratio, free cash flow, and dividend growth history to ensure that the dividend is sustainable. Consider dividend growers. Companies with a lower initial yield but a strong history of dividend growth often offer better long-term returns. A growing dividend indicates that the company is financially healthy and committed to returning profits to shareholders over time. Example. Imagine you're choosing between two companies. First company offers a 10% dividend yield, while the second company offers a 4% yield but has increased its dividend every year for the past 15 years. While the first company might seem attractive for its high yield, there's a risk that the dividend won't be sustainable. The second company, with its history of dividend growth, might offer more long-term stability and growth potential. Pitfall 2. Another common pitfall is failing to evaluate the sustainability of a company's dividend. Just because a company pays a dividend today doesn't mean it will continue to do so in the future. Companies facing financial pressure, declining earnings, or high debt levels may be forced to cut their dividends to preserve cash. How to avoid it? Check the dividend payout ratio. A lower payout ratio suggests that the company has enough earnings to cover its dividend, while a high payout ratio may indicate that the company is paying out too much of its earnings. Look at free cash flow. A company needs strong cash flow to support its dividend payments. Analyze the company's cash flow statement to ensure that it has enough cash on hand to cover its dividend. Research the company's dividend history. Companies that have consistently increased their dividends for many years are more likely to continue doing so. Look for dividend aristocrats or companies with a track record of reliable, growing dividends. Example. Imagine you're considering investing in a company that has a 90% payout ratio and declining earnings. While the dividend might seem attractive now, the company's ability to maintain it is questionable. By avoiding companies with high payout ratios and declining cash flow, you can reduce the risk of a dividend cut. Pitfall 3. Failing to diversify. We've already discussed the importance of diversification, but it's worth mentioning here as well because failing to diversify is a major pitfall for dividend investors. Many investors are tempted to put all their money into one or two high-yield stocks, hoping for quick returns. This strategy can backfire if one of those companies experiences financial difficulties, forcing it to cut or eliminate its dividend. How to avoid it. Diversify across sectors. Don't rely too heavily on one sector, like utilities or consumer staples. Spread your investments across multiple industries, such as healthcare, technology, consumer goods, and financials, to reduce risk. Consider adding international dividend stocks to your portfolio to protect against regional economic downturns. Hold a mix of dividend growth and high-yield stocks. A combination of stable dividend growers and high-yield stocks can balance both income and growth potential. If you invest heavily in energy stocks, for example, and oil prices fall, you could be exposed to significant losses. However, if you also own dividend stocks in sectors like healthcare or consumer staples, your portfolio will be better positioned to weather the downturn. Pitfall 4. Many investors miss out on the powerful effects of compound growth by failing to reinvest their dividends. Reinvesting your dividends allows you to buy more shares, which in turn increases your future dividend income. Over time, this can lead to exponential growth in your portfolio's value. How to avoid it. Set up a DRIP dividend reinvestment plan. Many brokerages offer automatic dividend reinvestment plans (DRIPs), which automatically reinvest your dividends into additional shares. This takes the guesswork out of reinvesting and helps you maximize compound growth. Even if you're manually reinvesting your dividends, make it a habit to reinvest consistently rather than taking the cash payments. For example, if you receive $1,000 in dividend payments this year and reinvest it into more shares, you'll be earning dividends on that $1,000 next year. Over time, this creates a compounding effect that can dramatically increase your wealth. Pitfall 5. Trying to time the market, buying stocks at the lowest point and selling them at the highest, is a strategy that rarely works. Many investors, hoping to maximize their returns, end up buying stocks at the wrong time or selling too early, missing out on long-term gains. How to avoid it. Focus on time in the market, not timing the market. Dividend investing is a long-term strategy. Instead of trying to time the perfect entry or exit, focus on staying invested for the long haul. The longer you stay invested, the more you benefit from dividend reinvestment and compound growth. Stick to your strategy, don't panic and sell during market downturns. Dividend stocks can provide a steady income even during periods of market volatility, so focus on the long-term picture. If you sell your dividend stocks during a market correction, you might miss out on the dividends and potential price recovery that follows. By staying invested through market ups and downs, you'll benefit from both steady income and long-term capital appreciation. Pitfall 6. Not rebalancing your portfolio. As your portfolio grows and market conditions change, some stocks will outperform others, potentially leading to an overconcentration in one sector or stock. This can increase your risk exposure if one stock or sector takes up a larger portion of your portfolio than intended. How to avoid it. Set a schedule to review and rebalance your portfolio, whether it's annually or quarterly. If one sector or stock has grown significantly, sell some shares and reinvest in underweighted areas to maintain balance. Instead of reinvesting all your dividends back into the same stock, consider using them to buy shares in other sectors or companies that are underrepresented in your portfolio. For example, imagine that your technology stocks have grown significantly and now make up 40% of your portfolio, far more than you intended. By rebalancing and reinvesting your dividends into other sectors, you can reduce your risk and maintain diversification, transforming pitfalls into learning opportunities. Mistakes in investing aren't the end of the world, in fact, they're some of the best learning opportunities. By understanding these common pitfalls and how to avoid them, you're not just preventing errors, you're becoming a more resilient and informed investor. Remember, successful investing isn't about being perfect. It's about making smart, informed decisions and staying the course, even when challenges arise. By avoiding these pitfalls, you'll be better positioned to achieve your long-term financial goals and enjoy the benefits of financial freedom. In the next chapter, we'll explore how and when to use your dividends to support your financial goals. Whether you plan to reinvest dividends for growth or eventually live off your dividend income, this chapter will help you navigate that transition with confidence. For now, take a moment to review your own investment strategy and ensure you're steering clear of these common pitfalls. By staying disciplined and avoiding these mistakes, you're setting yourself up for long-term success in your dividend investing journey. Chapter 10. When and how to live on your dividends. For many investors, the ultimate goal of dividend investing is to reach a point where they can live off their dividend income, achieving financial independence or supplementing their retirement. But deciding when and how to start using your dividends is a big step, and it requires careful planning to ensure that your dividend income supports your financial goals in the long term. In this chapter, we'll explore how to decide when it's time to start using your dividends, strategies for withdrawing your dividend income, and how to ensure that you don't outlive your investments. One of the most important questions dividend investors face is, when should I stop reinvesting my dividends and start using them for income? The answer depends on several factors, including your financial goals, lifestyle, and the size of your portfolio. Let's look at some key considerations. 1. Before deciding to use your dividends, take a step back and reflect on your overall financial goals. Are you aiming for early retirement, building a passive income stream, or supplementing your retirement savings? Understanding your why will help guide your decision-making. Example: if your goal is to retire early and live off your investments, you may need to wait until your portfolio reaches a size where the dividends can cover your living expenses. If you're simply looking for supplemental income during retirement, you may be able to start using your dividends sooner. 2. The size of your dividend portfolio is a major factor in deciding when to start living off your dividends. Ideally, your portfolio should be large enough to generate enough income to cover your living expenses without depleting your principal investment. This way, you can continue earning dividends for the rest of your life. A good rule of thumb is to aim for a portfolio that can generate 4% to 5% of your annual income needs in dividends. If your living expenses are $50,000 per year, for example, you'll need a portfolio that generates between $1 million and $1,250,000 in dividend income to comfortably leave off your dividends. 3. Are your dividends growing? Another important factor is whether your dividend income is growing over time. If you own companies with a history of consistently increasing their dividends, you may feel confident starting to use your dividends sooner, knowing that your income will continue to grow and keep pace with inflation. Once you've decided that it's time to start using your dividends for income, it's important to transition smoothly from reinvesting to withdrawing. This involves balancing your need for income with the goal of preserving your wealth over time. 1. Partial dividend reinvestment. One strategy for making the transition is to partially reinvest your dividends while withdrawing a portion for income. This allows you to continue growing your portfolio while still using some of your dividends to support your lifestyle. For example, if your portfolio generates $40,000 in annual dividends, but you only need $30,000 to cover your living expenses, you could withdraw $30,000 and reinvest the remaining $10,000. This way, you're still benefiting from the power of compound growth while using your dividends to cover your immediate needs. 2. Full dividend withdrawal. If your portfolio has reached the size you need to fully cover your living expenses, you may choose to withdraw 100% of your dividends. However, it's essential to monitor your portfolio regularly to ensure that your dividend income continues to meet your needs without reducing your overall investment value. This approach is especially useful for retirees who have reached their target portfolio size and are looking to fully rely on their investments for income. 3. Adjusting during market volatility. Market downturns can impact your portfolio's value, but if you've built a diversified portfolio of dividend-paying stocks, your income stream may remain steady. However, during periods of economic uncertainty, it's wise to revisit your dividend withdrawal strategy and consider temporarily reducing withdrawals or returning to partial reinvestment to safeguard your portfolio for the long term. Managing your dividend income. Once you start living off your dividends, managing that income effectively becomes just as important as growing your portfolio. Here are some strategies to help you stay on track. 1. Just like you would with a paycheck, it's important to create a budget that aligns with your dividend income. This will help ensure that your spending stays within the limits of what your portfolio can sustainably provide. Example: if your portfolio generates $60,000 in dividend income annually, create a budget that ensures you're not overspending. This will help you live within your means while maintaining the financial freedom that dividend investing offers. 2. Monitor dividend growth and adjust accordingly. As your dividend-paying companies increase their payouts over time, your income will grow. Keep track of your dividend growth and adjust your budget accordingly. This way, you can enjoy a rising income without touching your principal. For example, if your dividend income grows from $50,000 per year to $55,000 due to dividend increases, you can decide whether to increase your budget for discretionary spending or continue saving the extra income for future needs. 3. Be mindful of inflation. While many dividend-paying companies increase their payouts over time, it's important to remember that inflation can reduce your purchasing power. Keep an eye on inflation and consider adjusting your spending or dividend withdrawal strategy to ensure that your income keeps up with rising costs. Example: if inflation rises significantly and your dividend growth can't keep pace, consider reducing your discretionary spending to ensure that your core expenses are covered. Planning for the long term. When transitioning from reinvesting to withdrawing your dividends, it's important to have a long-term plan in place. By balancing income generation with portfolio preservation, you can enjoy financial freedom without worrying about running out of money. 1. Reevaluate your needs regularly. As you move through different stages of life, your financial needs may change. Reevaluate your dividend withdrawal strategy regularly to ensure that it's aligned with your current lifestyle and financial goals. Example: in the early years of retirement, you may want to spend more on travel or hobbies, while later in life, your expenses may shift toward healthcare or other essentials. Adjust your dividend withdrawals to match these changes while keeping your long-term financial security in mind. 2. Even when living off your dividends, it's essential to leave room for growth. By reinvesting a portion of your dividends or adjusting your withdrawals based on market conditions, you can ensure that your portfolio continues to grow, providing you with financial security for years to come. Transforming your dividends into financial freedom. Here's where the transformative approach comes in. Using your dividends isn't just about covering your expenses, it's about achieving true financial independence. You've built a portfolio that allows you to live life on your own terms, without relying on a traditional paycheck. This is the freedom that dividend investing offers. You've transitioned from growing your wealth to enjoying it, and with careful planning, your dividends will continue to provide you with the lifestyle you desire, for as long as you need them. By staying disciplined and managing your dividend income wisely, you'll continue to experience the benefits of financial independence for years to come. In the next chapter, we'll explore stories of real-life individuals who have achieved financial freedom through dividend investing. These stories will show you how different strategies can lead to the same ultimate goal: living life on your own terms, supported by the income from your investments. For now, take a moment to reflect on your own goals. Whether you're planning for retirement or early financial independence, think about how your dividends will support your long-term plans. By creating a thoughtful strategy for using your dividends, you'll be ready to make the most of your financial freedom. Chapter 11. Financial Freedom in Practice. Stories of Success. Every investor's journey to financial freedom is unique. For some, it's a steady climb with small, consistent investments. For others, it's a calculated shift in strategy later in life. But no matter the path, the destination is the same: achieving financial independence through the power of dividend investing. In this chapter, we'll explore real-life stories of people who have successfully used dividends to create the lives they've always wanted. These stories show that financial freedom is within reach, regardless of where you start or what challenges you face along the way. The steady saver. Grace's story is a testament to the power of patience and consistency. In her early 30s, Grace decided to take control of her finances. She didn't come from wealth, nor did she have a high-paying job. But what Grace did have was discipline, and a strong desire to create a better future for herself. For years, Grace diligently saved a portion of her salary every month, investing it into dividend-paying stocks. She wasn't focused on high-yield stocks. Instead, she prioritized dividend aristocrats, companies with a long history of increasing dividends. Her goal was simple: to build a steady stream of income that she could rely on in retirement. Grace also made a point to reinvest her dividends through a DRIP dividend reinvestment plan. She understood the power of compound growth and let time work its magic. Over the years, as her portfolio grew, so did her dividend income. By the time Grace reached her early 60s, she had accumulated a dividend portfolio large enough to provide her with $45,000 per year in passive income, enough to comfortably cover her living expenses. Today she lives a life of financial independence, enjoying her hobbies and spending time with family, all thanks to the patient strategy she started decades earlier. Key takeaways from Grace's journey. Consistency is key. Small, regular investments over time can lead to significant wealth. Dividend growth matters. Grace focused on dividend aristocrats with a history of increasing their payouts, which allowed her income to grow over time. Reinvest dividends. Grace reinvested her dividends for years, allowing her portfolio to compound and grow steadily. The late starter. David's journey is different from Grace's. He didn't start thinking about financial independence until his mid-50s, when he realized that his retirement savings were far behind where they needed to be. He had spent years working a comfortable job and enjoying life, but without much focus on investing. At 55, David decided it was time to take a more proactive approach to his financial future. He didn't have decades to build wealth, but he did have savings that he wanted to put to work. After doing his research, David discovered dividend investing and decided to make it the cornerstone of his retirement strategy. David focused on high-yield dividend stocks to quickly boost his income. He also diversified his portfolio across several sectors, including utilities, healthcare, and real estate investment trusts (REITs), to protect against risk. While his yields were higher than Grace's, David also made sure to invest in companies with a solid track record of maintaining their dividends. Within 10 years, David had built a portfolio that provided him with $30,000 per year in dividend income. Combined with his Social Security benefits, this was more than enough to support his retirement. David now enjoys a peaceful retirement, free from financial stress, knowing that his dividends provide him with a reliable income stream. Key takeaways from David's journey. It's never too late to start. David didn't begin investing seriously until his mid-50s, but with focus and discipline, he was able to build a significant income stream. High-yield stocks can work in the right situation. By focusing on high-yield dividend stocks, David was able to quickly generate income, but he balanced that strategy by ensuring the companies were financially stable. Diversification is crucial. David protected his income by diversifying across several sectors, reducing the risk of relying on any one company or industry. The early retiree. Sarah always dreamed of retiring early. In her 20s, she was inspired by the idea of financial independence and began looking for ways to make it a reality. Sarah didn't want to rely on a traditional career for her entire life, so she adopted a frugal lifestyle and directed as much of her income as possible into dividend-paying stocks. Sarah's strategy was to focus on a mix of high-dividend growth stocks and REITs. The REITs provided her with a higher yield to support her income, while the dividend growth stocks ensured that her income would increase over time. She also reinvested her dividends for the first 15 years of her investing journey, allowing her portfolio to grow significantly. By the time Sarah was 40, her portfolio was generating $50,000 per year in dividend income. Combined with her modest living expenses, this was enough for Sarah to achieve her dream of early retirement. Today she travels the world, pursuing her passions while living off the dividends from her carefully curated portfolio. Key takeaways from Sarah's journey. Early financial independence is possible. Sarah's disciplined approach and frugal lifestyle allowed her to retire at 40, far earlier than most people, combining yield and growth. Sarah's strategy of mixing high-yield REITs with dividend growth stocks gave her both immediate income and long-term growth. Reinvesting dividends for the first 15 years supercharged Sarah's portfolio growth, allowing her to reach her goal faster. The cautious investor. Michael's approach to dividend investing was one of caution and balance. A natural planner, Michael didn't want to take on too much risk, especially as he neared retirement age. He wasn't interested in the highest yields or the most aggressive growth strategies. What mattered most to him was stability. Michael built his portfolio around dividend aristocrats and blue-chip stocks, focusing on companies that had a strong reputation for consistent payouts and financial stability. He also avoided high-yield stocks that he considered too risky for his conservative approach. By reinvesting dividends for several decades and avoiding major market risks, Michael built a portfolio that provided him with $35,000 per year in passive income by the time he retired at 65. Michael's strategy wasn't flashy, but it was exactly what he needed for peace of mind. He now enjoys a quiet retirement, knowing that his portfolio will provide him with a steady income for years to come. Key takeaways from Michael's journey. Stability matters. Michael's conservative approach to dividend investing allowed him to build a steady income stream without taking on unnecessary risk. Dividend aristocrats are reliable. By focusing on companies with a history of consistent payouts, Michael ensured that his portfolio was built on strong foundations. Caution can still lead to success. Even without chasing high yields, Michael's cautious approach allowed him to achieve financial independence by retirement. These stories show that financial freedom through dividend investing is possible, no matter where you start or what your goals are. Whether you're a steady saver like Grace, a late starter like David, an ambitious early retiree like Sarah, or a cautious planner like Michael, the key is to find a strategy that aligns with your goals and stick with it. Each of these investors took control of their financial future through dividend investing, and so can you. Their paths may have been different, but their commitment to building a reliable income stream through dividends led them all to financial independence. In the final chapter, we'll wrap up with a reflection on the power of dividend investing and a reminder that anyone can achieve financial freedom with the right mindset and strategy. You've learned the tools and techniques. Now it's time to take action and create your own path to financial independence. For now, take a moment to think about your own journey. What's your strategy? How can you apply the lessons from these real-life success stories to achieve your financial goals? Remember, the journey may take time, but with discipline and persistence, financial freedom is within your reach. Chapter 12. Staying the course. How to maintain your financial independence. You've come a long way in your journey to financial freedom. From understanding the basics of dividend investing to learning how to build and manage a diversified portfolio, you now have the tools and knowledge to create a reliable stream of income that will support your financial goals for life. This final chapter is a reflection on the power of dividend investing, the lessons you've learned, and, most importantly, a reminder that taking action is the key to unlocking your financial future. Whether you're just starting or already well on your way, the journey to financial independence requires discipline, patience, and a clear vision of where you want to go. The power of dividend investing. Dividend investing isn't just a strategy, it's a way to transform your financial life. By focusing on building a portfolio of income-generating assets, you're creating a future where you no longer need to trade your time for money. Instead, your money works for you, generating passive income that supports the lifestyle you want to live. Over the course of this book, we've explored the power of dividend growth. Choosing companies that consistently increase their dividends over time, ensuring that your income grows alongside your wealth. Compound growth. Reinvesting dividends to harness the incredible force of compounding, which accelerates your portfolio's growth and leads to exponential wealth accumulation. Protecting your income and reducing risk by spreading your investments across different sectors, industries, and regions. These key pillars of dividend investing are the foundation for achieving financial independence. You now have the knowledge to implement these strategies in your own life, but knowledge alone isn't enough. The most important step is to take action. The road to financial independence through dividend investing isn't a quick one. It requires long-term thinking, patience, and a commitment to staying the course, even when markets fluctuate or times feel uncertain. One of the most important traits of successful dividend investors is the ability to think long-term. The stock market will have its ups and downs, but by focusing on quality dividend-paying stocks and staying invested, you'll continue to build wealth over time. Remember that the key to success isn't timing the market, it's time in the market. The longer you stay invested, the more your dividends and portfolio will grow. At the heart of dividend investing is the promise of financial freedom, the ability to live life on your own terms, without worrying about where your next paycheck is coming from. Whether your goal is early retirement, supplementing your income, or simply building a safety net, dividends offer a reliable path to achieving that freedom. Imagine waking up every day knowing that your investments are generating enough income to cover your living expenses. You can choose how to spend your time, whether it's traveling, pursuing hobbies, spending time with loved ones, or giving back to causes you care about. This is the reality that dividend investing can create. Now that you've completed this book, you're equipped with the knowledge, tools, and inspiration to start, or continue, your own journey to financial independence. But what comes next? Here are some steps you can take right now to begin putting your plan into action. 1. Evaluate your current financial situation. Take a moment to assess where you are today. What are your financial goals? How much do you need to generate in passive income to achieve those goals? 2. Build or refine your dividend portfolio. Whether you're starting from scratch or refining an existing portfolio, focus on quality dividend-paying companies. Use the strategies you've learned in this book to select companies with strong dividend histories, solid financials, and room for growth. 3. Reinvest your dividends. If you're still in the wealth-building phase, commit to reinvesting your dividends to maximize compound growth. Set up a DRIP or manually reinvest your dividends to accelerate your portfolio's growth. 4. Stay disciplined and patient. Investing is a long-term game. Don't be swayed by market fluctuations or short-term thinking. Stick to your strategy, stay diversified, and trust the process. 5. Financial goals evolve, and so should your strategy. Take time to revisit your plan every year, adjusting as needed to ensure that your portfolio aligns with your goals. Final words. The journey to financial freedom isn't always easy, but it's absolutely worth it. By taking control of your finances, you're creating the life you want, one that offers freedom, flexibility, and peace of mind. Dividend investing provides a powerful vehicle for achieving this freedom, but the real key is your commitment to staying the course. Remember, financial independence doesn't happen overnight. It's built day by day, investment by investment, decision by decision. But with discipline, patience, and the strategies you've learned in this book, you have everything you need to succeed. Now it's up to you. Take the next step. Start building your dividend portfolio. Stay disciplined, stay patient, and watch your wealth grow over time. Financial freedom is within your reach, and you have the power to make it a reality. Take care and be well.